For centuries, people have wondered how Jewish families build and maintain wealth generation after generation. It's not luck. It's not some secret network. It's that Jewish tradition teaches a set of financial laws that 99% of people either ignore or never learn. And the irony is, these laws start with breaking the rules everyone else follows. The world tells you to save your way to wealth. The Torah tells you to build. The world tells you to play it safe. The Talmud tells you to be strategic with risk. The world tells you to diversify everything. The sages tell you to concentrate where you have wisdom and spread thin only where you don't. For over 40 years, I've counseled billionaires, business owners, and ordinary families as a rabbi, through fortunes made and fortunes lost. And the pattern is always the same. Money doesn't follow rules, it follows laws. These laws operate on three principles: momentum, structure, and asymmetry. Law number 1. Money loves speed, but wealth loves patience. In Jewish thought, there's a concept called l'dor v'dor, from generation to generation. The sages never thought in terms of quick wins. They thought in terms of what endures. I counseled 2 men who both got into real estate the same year. The first flipped close to 100 properties in 5 years and made decent cash. The second bought 1 rental, then a 4-plex, then a 20-unit building. At the end of 5 years, the second man's net worth was 5 times greater, because he let time do the heavy lifting. Speed is the shortest distance between seeing an opportunity and acting on it. That matters. But wealth is what happens when you make a sound decision and hold it long enough for compounding to take over. The great mistake is confusing fast action with fast results. Act quickly, then be patient. Time is the best business partner you will ever have. Law number 2. He who gives the money holds the power. The Talmud teaches that the lender stands above the borrower, not morally, but structurally. The one who provides the resources sets the terms. Look at the wealthiest people in the world. Almost none got there on salary. The vast majority are buyers and builders. They acquire assets, improve them, and hold them. The person deploying capital captures the upside. You don't need millions to start. You need to understand the strategy. The wealthiest families I've counseled all share this obsession. They are always looking for what to acquire, what to build, and what to hold. They think like buyers, even when they're small. Law number 3, leverage multiplies everything. In Hebrew, koach means strength or force. Say you buy a property for $1 million in cash. It appreciates 10%. You made 10% on your million. But if you put $200,000 down and borrowed $800,000, that same appreciation gives you a 50% return on your cash. Same house, 5 times the return. The only difference was leverage. This principle built entire industries, private equity, commercial real estate, all of it. And the wealthiest people I've worked with use leverage to access capital without triggering taxes. They borrow against what they own. Their holdings become collateral. Because leverage is not income, and where there's no income, there are no taxes. But leverage cuts both directions. The wise way treats it as a tool of discipline. The reckless way treats it as a shortcut. Law number 4. Cash flow keeps you alive, but equity makes you free. The Talmud distinguishes between parnasa, daily sustenance, and osher, true wealth. Cash flow is parnasa. It pays your bills today. Equity is osher. It's the wealth you're building for tomorrow. Every family I've counseled who truly broke through understood this. They used their cash flow to acquire equity, a piece of a business, shares in a company, ownership in property. They didn't just earn to spend, they earned to own. Your job is to use what you earn today to buy what will set you free tomorrow. Law number 5. Risk and reward are not equal. Most people assume risk and reward scale evenly. They don't. They're non-linear. A venture fund makes 5 equal investments. 2 go to 0. 1 breaks even. 1 returns 10 times. 1 returns 100 times. Those last 2 don't just cover the losses. They generate wealth that dwarfs the original investment many times over. The downside was capped. The upside was open. That's asymmetric risk and reward. Your job is to structure investments where you know the most you can lose, but the potential gain is many multiples of that. But asymmetric upside does not mean going all in. Which brings us to the law I've taught more than any other. Law number 6, never risk the empire for a pot of gold. Solomon wrote, "A good man leaves an inheritance to his children's children." You can't leave an inheritance if you gamble away the foundation. I sat with a couple who spent 15 years saving nearly $700,000. A friend brought them a deal. Great returns, tax advantages, compelling story. They put everything in. 2 years later, the deal collapsed. 15 years gone in one decision. The lesson isn't about the deal, it's about the size of the bet. The Talmud warns against placing all your goods on a single ship. 2,000 years ago, the sages already understood concentration of risk is the fastest path to ruin. The best investors don't try to maximize returns. They reduce risk while keeping returns steady. Protect the machine first. Swing for upside only after the foundation is secure. Law number 7, diversify only where you don't understand. Wall Street tells you to spread your money across everything. Every wealthy person I've counseled does the opposite. It comes down to 2 factors, understanding and control. When you deeply understand the risk and have direct control, like your own business, you concentrate. When you understand the risk but don't have control, you invest with confidence but size it carefully. When you have neither understanding nor control, that's when you diversify widely. That's not strategy, that's survival. Most people diversify everything because they understand nothing. The wealthy concentrate because they've done the work to understand deeply. Now, knowing these laws isn't enough. Before any investment, ask 5 questions. Can this compound over time? Who has control? What happens if it fails? Is the upside meaningfully larger than the downside? And can you explain how the business actually works? The Mishnah teaches, who is wise? He who learns from every person. These laws came from 40 years of sitting with people at kitchen tables, in my study, in boardrooms, watching what builds and what destroys. The laws don't change. The question is whether you'll use them.